Welcome to the Deep Dive. Today, we're zeroing in on the digital content world, specifically PodcastOne. We're cutting through their fiscal Q1 2026 earnings update. That dropped August 13th, 2025.
Yeah, this was one people were definitely watching. After some pretty wild stock swings, the market really needed to see proof that management strategy was working. Building scale, sure, but more importantly, getting towards profit.
Exactly. So our mission here is to pull out those key drivers, the critical data points, just to give you a really solid picture of where this business seems to be heading.
Do it.
Okay, let's jump right into the headline numbers. These definitely gave the stock a bit of a boost, some cautious optimism. Revenue came in at $14.99 million for the quarter.
Which is solid. That's a 14% growth year over year, and it just squeaked past the consensus estimate, which was around $14.9 million. So a slight beat, but a beat nonetheless.
A top-line beat is always good. But the real story, I think, was further down the P&L, the GAAP net loss per share. Negative $0.04.
Right. Still a loss, obviously, but better than the street expected. They were forecasting negative 5 cents. So it kind of hints that maybe cost discipline is starting to take hold a bit.
But the number that really got the market buzzing, the major milestone here, was that flip to positive adjusted EBITDA. They reported $0.58 million. Positive.
Yes, a massive swing from the loss they posted in the same quarter last year.
That really seemed to be the catalyst.
It was. You could see it in the market reaction. That combination beating on revenue even slightly, and then showing that operational pivot to positive adjusted EBITDA, even on an adjusted basis.
Well, it just changes the whole conversation around the company, doesn't it?
Moves them out of that growth at any cost category, maybe.
Exactly. It suggests there's some leverage in the business model finally showing through.
Okay, so leverage is key. Before we dive deeper into the financials, let's just quickly touch on the operational side. They are clearly still focused on scale. Added 14 new shows this quarter.
Yep. Brings the total active slate up to 206 podcasts. They're keeping the pipeline full. And that scale seems to be translating into, actual market presence. They mentioned holding on to their top 10 U.S. podcast publisher rank from Podtrac.
For the 8th month running, number 9, actually.
Yeah.
Which, it underlines their distribution strength. They're reaching, over 5 million unique listeners in the U.S. each month? That's significant reach.
Okay, reach is there. Let's pivot back to the financials, specifically that nuance between GAAP and adjusted EBITDA, because this is where things can get a bit confusing for people. We cheered the positive $0.58 million adjusted EBITDA, but then you look at the GAAP operating loss, and it's still negative $1.05 million. How do we square that?
Yeah, that gap is really crucial to understand. GAAP, generally accepted accounting principles, that's the standard accounting. It includes everything, all the expenses, cash, non-cash, like depreciation, amortization, and importantly for a company like this, stock-based compensation.
Right, SBC. So the GAAP loss means the accountants still see red ink on the official books. But the positive adjusted EBITDA suggests that the core day-to-day operations, once you strip out things like that non-cash stock comp, are actually starting to generate positive cash flow. Is that fair?
That's a very fair way to put it. The underlying unit economics are improving. It shows the basic engine of the business making content, selling ads, is now structurally profitable on that adjusted basis.
And they provided some supporting numbers there too, right? Contribution margin?
They did. About $2.4 million, which works out to roughly 16%. Not amazing, but respectable. And importantly, they finished the quarter with a relatively clean balance sheet, $1.9 million in cash, and crucially, 0 debt.
Okay, so the current picture is improving but complex. What about looking forward? Management sounded pretty confident, reiterating their full-year guidance for fiscal 26. They're calling for record results.
Oh, yeah. They're definitely aiming high. Full-year revenue guidance is between $55 million and $60 million.
Wow.
And for adjusted EBITDA, they're projecting between $3 million and $5 million. That's a pretty significant jump from this quarter's run rate.
That demands some serious execution, especially hitting that high end, the $60 million revenue and $5 million adjusted EBITDA. And this is where the strategy gets, well, interesting. Maybe a little concerning.
How so?
They explicitly said reaching that high end depends directly on the size and timing of potential acquisitions.
Ah, right. The M&A factor.
Oh.
That's the big variable, isn't it?
Yeah.
Management's basically telegraphing, look, we think we can hit the low end organically, but if you want the really great numbers, we need to buy some gross and profit.
Doesn't that feel like a bit of a red flag for organic growth potential? Like you're admitting you can't quite get there on your own steam?
You could read it that way.
Yeah.
Or you could see it as strategic acceleration. They want to scale fast, maybe faster than purely organic growth allows. So instead of building everything in-house, they plan to buy complementary assets, accretive deals to hit those targets quicker.
So M&A becomes a critical catalyst to watch this year then.
Absolutely. It's baked into the high end of their own forecast.
Okay, let's put a pin in M&A for just a second and look at the organic drivers they do control. Monetization specifically. What really jumped out at me was this massive shift towards video.
Oh yeah, that 218% surge in video views year over year, that's huge. Across YouTube, TikTok, Spotify, everywhere.
It feels like a fundamental change for a company named PodcastOne, right? Moving beyond just audio.
Definitely. It's an acknowledgement that audiences consume content everywhere, not just in the traditional podcast feed. And that video growth isn't just for show, it's a direct lever they're pulling to boost revenue.
Explain that connection, though. How does more YouTube views translate into higher revenue for, say, an audio ad spot?
It's clever, actually. They aggregate both the audio listens and the video views when they calculate their total impression delivery.
Ah, okay.
So when they sell ads based on CPM cost per 1,000 impressions or even just spot rates, they can point to this larger combined audience number. More impressions means they can justify charging higher blended rates per ad.
But isn't there a risk there? Advertisers usually value video views and audio listens differently. Are they potentially muddying the waters or devaluing the pure audio ad by bundling them like that?
That's the potential friction point for sure. And it seems like they're trying to address it by evolving the ad creative itself. They're pushing talent to move beyond just reading an ad into the mic.
Right.
And actually film visually engaging video commercials, especially for platforms like YouTube.
Yeah.
The idea is if the video ad performs better, drives more clicks or conversions, then that higher blended CPM feels more justified to the advertiser. It's about making the whole package more valuable.
An evolution in the ad product itself. Got it. Okay, that covers the revenue side. What about costs? The efficiencies that helped get them to that positive adjusted EBITDA figure. They mentioned migrating their platform to Amazon's R19 service. What is that exactly?
Yeah, R19 is essentially a distribution and hosting partnership with Amazon Web Services. The immediate benefit was cost savings, better tech, more efficiency. But the really interesting part, it apparently came with some guaranteed cash flow based on impression volume.
Guaranteed cash flow. How does that work?
Think of it like Amazon providing a sort of minimum floor price or maybe a rebate structure tied to hosting costs in exchange for distributing PodcastOne's content. It basically gives them a bit of a safety net on the operational expense side, smoothing out some of the volatility in ad impressions month to month.
Okay, that helps stabilize things. They also talked about attacking cost of sales. It's currently around 90% of revenue, which sounds really high.
It is high. It means for every dollar coming in, 90 cents is going right back out just to deliver the content and pay talent. They're targeting getting that down to the 87% to 89% range throughout the year.
How are they planning to do that? Lowering talent payouts?
Well, not exactly lowering the amount, but changing the form of the payout. This is where that stock-based compensation, SBC, comes back in again. It's a key mechanism.
Okay, unpack this for us. How does paying talent in stock instead of cash actually lower the cost of sales percentage? It's still an expense, isn't it?
It is absolutely still an expense on the overall books, but it's about where it hits the financial statements and how it's treated in key metrics. When they pay talent their revenue share in cash, that cash outflow hits the profit and loss statement directly as a cost of sales. It reduces gross profit.
Okay.
But when they use SBC, stock-based comp, it's accounted for differently. It's often listed further down the P&L or sometimes broken out separately. Crucially, it's a non-cash expense.
So if I'm following this, they're essentially swapping a cash expense that directly hits cost of sales for a non-cash expense that gets added back when you calculate adjusted EBITDA.
You've got it exactly. That's the structural shift they're making. It achieves two things immediately. One, it preserves cash on the balance sheet, which is always good. And two, since adjusted EBITDA specifically excludes non-cash items like SBC, the resulting adjusted EBITDA number and margin look significantly better.
So it's a direct lever to help them hit that $3 million to $5 million adjusted EBITDA target for the year.
Precisely. It makes that target feel much more achievable, even if the GAAP losses persist for a while longer. It's smart financial engineering, tailored to the metrics the market is focusing on right now.
Which brings us back full circle to M&A, since that's tied to the revenue target. What signals did they give about the deal pipeline? Are they actively looking?
Extremely active. Based on their commentary, they're looking at two main types of targets. First, the obvious one, smaller podcast networks, maybe groups of shows, to just bolt on more audience and add inventory.
2 cents. And the second?
The second is more strategic, focusing on technology companies within the podcasting space.
Technology. Like what?
Specifically, they mentioned tech related to processing video impressions and handling delivery reports, which ties right back into that huge 208% video growth we talked about.
Right.
They need the back-end systems to actually manage and monetize all that complex, multi-platform video inventory effectively.
Okay, so they need the tech to support the strategy. The big question then, is a deal actually close? Or is this just typical earnings call talk about exploring opportunities?
Well, this is where it got interesting. Management put a time frame on it. They explicitly said there's a good opportunity for M&A announcements within the next 90 days.
90 days, that's quite specific.
Very specific. It makes it a critical near-term catalyst. Investors waiting for confirmation on that high-end guidance now have a window to watch.
Excellent breakdown.
Yeah.
Okay, now it's time for our favorite segment. We put on our imaginary hedge fund analyst hats
Uh-oh.
and propose an outrageous, but maybe just plausible trade idea based only on what we heard in this earnings call.
All right, but first, the mandatory, a very serious disclaimer. This is absolutely not financial advice. We are purely speculating for informational and entertainment purposes. Please do your own research before making any investment decisions. Seriously.
Couldn't agree more. Okay, disclaimer delivered. So, the setup. The stock got a bump, but it's still way off its recent highs, maybe 30–40% down from the summer peak. The market seems unconvinced, perhaps suffering from a case of show-me syndrome regarding sustained profitability. What's the play?
Okay, the premise is exactly that. Market skepticism. Despite the positive adjusted EBITDA flip and the strong guidance, there's doubt about whether they can really scale these profits consistently. They need more proof.
And the catalyst to shatter that skepticism?
It has to be M&A. Management literally handed it to us on a silver platter. They put that 90-day potential timeline out there, and they explicitly linked acquisitions to hitting the high end of their own FY26 guidance, that $60 million revenue, $5 million adjusted EBITDA number.
Okay, so the catalyst is clear and time-bound, potentially. How do you structure the trade?
The idea is a short-term leveraged long position, specifically buying call options, maybe expiring late in Q4 2025, so after that 90-day window closes.
Call options, betting on a price increase.
Right. The thesis is pretty straightforward. Any M&A announcement within that 90-day period, even if it's a smaller tuck-in deal focusing on tech or operational efficiency, will serve as powerful validation. It proves management can execute on the strategy they laid out.
And that proof of execution is enough to move the stock.
The bet is that it will. The announcement itself should rapidly close the psychological gap between the current valuation, which reflects skepticism, and the potential valuation implied by hitting that high-end guidance, which relies on M&A. It's essentially a bet on a near-term sentiment reversal, triggered by management delivering on their M&A promise.
A leveraged bet that management pulls the M&A trigger within roughly 90 days, validating the path to $60 million. Bold, but, as you said, based directly on their own statements.
It hinges entirely on them following through within that time frame they themselves suggested.
Okay, let's wrap up this deep dive. Core takeaways for you, the listener. PodcastOne is executing on scale, top 10 rank, 14% revenue growth prove that. The flip to positive adjusted EBITDA is a huge operational win, helped significantly by some clever financial engineering with SBC.
They're looking forward, it really boils down to two things. Can they keep monetizing that massive surge in video effectively? And critically, can they execute on the M&A they've signaled is necessary to hit the top end of their guidance within the next few months?
Which leads us to our final provocative thought for you. We're seeing PodcastOne integrate video deeply and use stock comp strategically to manage costs. This looks like it's fundamentally shifting their business model, maybe making it feel more like a traditional media company than just a pure-play podcast network.
So the question you should be asking yourself is this positive adjusted EBITDA we saw this quarter the start of a durable structural trend driven by these changes? Or was it just a well-executed quarter, a one-off win that might be harder to repeat consistently as costs inevitably rise over time?
Something to think about. Thank you for joining us for this deep dive. And one last time, please remember, everything discussed here today was for informational purposes only. It absolutely does not constitute financial advice.